Good morning, everyone. Thank you for joining us on Morning Markets today. Firstly, we'll look at asset markets and how they performed yesterday, and then we'll come on and look at some of the economic data as well. So just looking back at the performance of asset markets yesterday, really not a lot to report from an equity market perspective. We did see indices come off slightly in terms of the FTSE 100 here in the UK, down about 10 basis points in the day. Similar performance looking across to the US, S&P basically flat, Nasdaq down 20 pips on the day. Probably slightly different performance in Europe to an extent, driven in large part by what was happening in Germany, where the German market was a little bit weaker, just ahead of an announcement around how COVID-19 restrictions were either going to be relaxed, changed, etc. Some speculation had been that they would be extended in their current form for another month. That seems to have been not entirely correct, and some changes have been made there, but a very gradual changes envisaged there. Just looking then in terms of other asset markets over the course of the day, if we look at the sovereign bond markets in general, not a lot to discuss there really. Yields have continued to remain where they were at the beginning of the week. If you think about the US, we've come in marginally to about 1.13%. The UK 10-year gilt 0.48%, so no real significant changes there. The key debate and the discussion point around the movement in sovereign bonds is primarily around the debate on inflation and how inflation will evolve over the coming months and indeed over the longer term. And I'll come on and discuss that in a moment or two, just looking at data from the US yesterday. Currency markets, really it continues to be a story of sterling looking to continuing to grind higher over the course of this week and over the past number of weeks indeed. So whilst we did see the dollar marginally weaker on a trade weighted basis yesterday, sterling continues to perform well, and indeed we've moved up to that 138 level, 138.4 yesterday. So positive performance coming through there from sterling relative to the dollar. Relative to the euro, pretty much unchanged. So that just gives you a sense of where the strength is coming from and where the weakness is also being evidenced. I touched on over the past couple of days just the various different inflation data points that we've been seeing. Yesterday it was the US's turn to give us the inflation numbers, and if we look there, what did we see? Well, we saw really no change on a month-on-month basis for inflation in January. If we look at it on a year-on-year basis, a core measure excluding the more volatile energy and food, from that we see inflation at 1.4% year-on-year. So missing the forecast very marginally of 1.5%, but really inflation very subdued at this point in time. The focus of the market is on the direction of inflation and how inflation will evolve. One of the things that we've been discussing and thinking about is just as we move through the next number of months, we will very evidently have inflation in the system on a year-on-year basis, just given the very low starting points that we will have for a number of costs as we annualise the impact of COVID-19, particularly in commodity markets, energy markets, etc. Thinking about that probably gives rise to a temporary increase in inflation as we annualise those numbers out. The question is, do they persist longer term? And that will be something that we, other market participants, will be debating, discussing and trying to form a view on over coming months. I think the Fed gives us some insight and central banks give us some insight into that at this point in time. They don't see any inflationary concerns, and indeed if we think about and listen to some of the rhetoric that they have been speaking, they are very much intent on remaining very accommodative from a monetary policy perspective, both in terms of interest rates but also in terms of their quantitative easing programs. And indeed the Federal Reserve, they've got a target of 2% inflation. Bear in mind that is on personal consumption expenditure, so not just the CPI number that we've been discussing. It typically runs a little bit lower than CPI, so there's a lot of scope there to get us to a 2% average target. think the other point to really keep in mind from the Federal Reserve's perspective is they have a dual mandate. One is on the average inflation rate, but it's also achieving full or maximum employment. And as we know, we're a long way from that at this point in time. So there's a number of factors there. The added complication to that is just the fiscal support packages that we've got, and in particular the 1.9 trillion that's being discussed in the US, some 9-10% of GDP. That comes through, that again could have an influence on inflation. But as I say, that's something that we will continue to monitor in the coming weeks and indeed months. I think the other things just to touch on, we now are into the Chinese Lunar New Year holiday period, so not a lot of data will be coming out of Asia over the next couple of days, and indeed into a large part of next week as well. So that may give sort of pause for thought in terms of economic data coming through, and also market activity.
Subscribing to True Potential YouTube channel is quick and easy. Simply go to your YouTube app on your phone, type in True Potential and press the red subscribe option. You'll then be notified as and when new videos are released.